When making a decision, it's important to consider all the costs and benefits involved, and prepare an analysis to determine whether a product line or business segment should be added or dropped. However, not all costs and benefits are created equal. Some are more relevant to the decision at hand, while others are less important. To make effective decisions, first define alternatives, then identify relevant costs and benefits while ignoring irrelevant ones. Use differential analysis to focus on future costs and benefits that differ between alternatives, including differential costs, differential revenue, incremental costs, and avoidable costs. Sunk costs are irrelevant and opportunity costs should be considered. To analyze and make decisions regarding business operations and investments, we can use the total cost or differential cost approach. The total cost approach considers all costs associated with each alternative, while the differential cost approach focuses on the differences between the costs and benefits of each alternative. Next, to determine whether a product line or business segment should be added or dropped. To do this, you'll need to look at the costs and benefits of each segment and compare them to each other. Sometimes, when we calculate the profits of a product, we also include some costs that the company cannot avoid, like rent or salaries. These costs are called common fixed costs. When we include these costs in the calculation, it can make the product look like it's not making any money or even losing money. But if the company stops making that product, they would still have to pay those same costs and their overall profits would decrease. So, even if a product appears to be unprofitable because of these common fixed costs, it may still be worth keeping because it actually contributes to the company's overall profits. By identifying relevant and irrelevant costs and benefits, and using cost-benefit analysis to compare different business segments, you'll be able to make more informed decisions and improve the success of your business. To prepare a make or buy analysis, you need to compare the costs of producing a product in-house versus buying it from an outside supplier. This analysis takes into account all of the costs associated with each option, including labor, materials, equipment, and overhead. By comparing these costs, you can determine which option is more cost-effective for your business. If the cost of producing the product in-house is lower than the cost of buying it from an outside supplier, it makes sense to make the product in-house. However, if the cost of buying the product is lower, it may be more cost-effective to outsource production. In the context of a make or buy analysis, the opportunity cost is the cost of not choosing the alternative option. For example, if a company decides to make a product in-house, the opportunity cost is the revenue or profit that could have been generated by the alternative use of space, if the company had instead chosen to buy the product from a supplier. When a customer places a special order, you need to analyze whether it's profitable for your business to accept it. This analysis takes into account the cost of producing the product, the price the customer is willing to pay, and any additional costs associated with fulfilling the order. If the cost of producing the product is lower than the price the customer is willing to pay, accepting the special order makes sense. However, if the cost of producing the product is higher than the price the customer is willing to pay, it may not be profitable to accept the order. By preparing a make or buy analysis and a special order analysis, you can make informed decisions about how to run your business and ensure profitability. Every business has limited resources, and how you allocate those resources can make or break your profitability. Imagine you have a production line with a bottleneck, a resource that limits the output of the entire line. By analyzing the costs and revenues of each product that could be produced with that resource, you can determine which product will generate the most profit. Once you've determined which product is most profitable, you can allocate your constrained resource accordingly, maximizing your overall profitability. Next, to determine the value of obtaining more of a constrained resource. In some cases, it may be worth investing in additional resources to eliminate a bottleneck altogether. But before you make that investment, you need to calculate the expected return on that investment by analyzing the costs and revenues of each product that could be produced with the additional resources. Our final objective is to prepare an analysis showing whether joint products should be sold at the split-off point or processed further. By analyzing the costs and revenues of each product that could be produced from the raw material, you can determine whether it's more profitable to sell the joint products at the split-off point or to process them further. By understanding these objectives, you can gain a better understanding of how to optimize the use of resources in a business setting, particularly when dealing with limited resources.